Hi there. If you're retired with a SIPP, the inheritance rules are changing. In the next few minutes, you'll know the 3 steps to take before April 20.
For decades, UK business owners and contractors have relied on a specific strategy for intergenerational wealth transfer, leaving surplus capital inside a self-invested personal pension, or SIPP. Under the current framework, most pensions operate as discretionary schemes. Because the scheme administrators ultimately decide who receives the death benefits, the funds legally sit outside the deceased's personal estate. This shields the capital entirely from inheritance tax. That legal boundary vanishes on the 6th of April 2027. The government has legislated that unused pension funds and death benefits will be legally absorbed into a person's estate for inheritance tax valuation. The distinction between discretionary and non-discretionary schemes is being abolished. Welcome to an Insight Engine briefing, produced in partnership with Pro Tax Accountant. Today, we are mapping the exact mathematics of this new legislation, exposing a severe dual tax trap and outlining the strategic restructuring required to protect your capital. This shift ends the era of tax-free pension inheritance and forces these funds into the center of the HMRC valuation process. To understand the financial impact, we need to look at a new calculation requirement known as the apportionment algorithm. This rule forces executors to mathematically split the tax-free allowance, the nil rate band, across different types of assets. This comparative ledger shows the government's own baseline scenario. We have an individual named Amir who dies at age 80, leaving a free estate of £1 million and a SIPP valued at £400,000. Looking at the left side under the current rules, the £325,000 nil rate band applies exclusively to the free estate. Subtracting the allowance and applying the 40% tax, the inheritance tax liability sits at £270,000. The SIPP passes untouched. On the right side, under the 2027 rules, the free estate and the SIPP are combined, creating a single taxable base of £1.4 million. Because the pension is now part of the estate, the £325,000 nil rate band must be sliced proportionally. The allowance is ratioed out between the property and the pension fund based on their respective values. This mathematical shift increases the total inheritance tax liability to £430,000. The responsibility for paying this is also split. The personal representative pays the tax on the free estate. However, the pension scheme administrator is now legally required to deduct their apportioned share, in this case nearly £123,000, directly from the SIPP before any remaining funds can be released to the beneficiaries. Company directors across the UK are currently reviewing their legacy plans, relying on financial modeling that uses mathematically obsolete assumptions. The apportionment rule forces an immediate, unavoidable liquidity drain directly from the pension fund itself, long before the wealth actually transfers to the next generation. For business owners who die on or after age 75, combining these assets triggers a severe secondary mechanism, the dual tax trap. This graphic illustrates the first layer of taxation. The pension scheme administrator executes the 40% inheritance tax deduction at the source. Because the deceased was over 75, the funds are subject to a second layer of taxation. When the beneficiary withdraws the remaining pension capital, they must pay income tax at their own marginal rate. The exact same corporate asset is taxed twice, first by inheritance tax on the principal, and then by income tax upon distribution. There is another hidden consequence of absorbing pension assets into the main estate, and it impacts the property allowance, known as the residence nil rate band. This chart details the residence nil rate band, an additional £175,000 tax-free allowance available when passing a primary home to direct descendants. However, it is capped by a strict £2 million estate limit. By forcing large SIPP balances into the estate valuation, the 2027 rules will inadvertently push thousands of directors over that £2 million threshold. Once over that line, the taper penalty activates. For every £2 the estate exceeds the limit, £1 of the property allowance is permanently erased. When you factor in double taxation and the erosion of the property allowance, the total loss can significantly exceed the baseline 40% headline rate. Planning for a single flat deduction is no longer a viable professional strategy. Beyond the mathematical penalties, this legislation places a strict new operational and compliance burden directly on the estate. Upon death, personal representatives have a hard 4-week deadline to identify all pension assets and obtain exact valuations from the providers. The representative must then calculate the exact nil rate ban apportionment across the entire estate and transmit that specific data back to the pension scheme administrator. The scheme administrator then has exactly 6 months from the end of the month of death to file an accounting for tax return and pay the total liability to HMRC. If this sequence breaks down, compounding late payment interest is applied directly to the pension funds, further eroding the capital. Maintaining clearly updated expression of wish forms is now critical. Any ambiguity over beneficiaries will create severe compliance bottlenecks and trigger those late penalties. The 2027 rules transform executors from passive administrators into active data managers, racing against an aggressive HMRC countdown. The 2027 rules change the underlying logic of pension planning. Directors who keep surplus capital in a drawdown fund now face a direct drain on their estate's total liquidity. There are specific mitigation pathways that remain intact under the draft legislation. The first is spousal exemption. Pension funds transferred directly to a surviving spouse or civil partner remain shielded from inheritance tax. The second is the charity exemption. Death benefits paid directly to a qualifying registered charity will not trigger an IHT charge. And the third is the active death and service exemption, which protects certain lump sums paid while a member is still employed. Outside of these specific exemptions, all standard drawdown and wealth accumulation strategies must be mathematically reevaluated immediately to avoid the dual tax traps. Please note, the information discussed here is based on draft HMRC legislation proposed for 2027. It is provided for educational purposes and does not constitute formal tax or legal advice. Navigating the intersection of corporate tax, income tax, and these new inheritance tax rules requires precision financial engineering. ProTax Accountant is a specialized firm dedicated to protecting the wealth and corporate structures of UK businesses, directors, and contractors. To initiate a comprehensive review of your tax position, call 07985 689 912, email info@protaxaccountant.co.uk, or visit www.protaxaccountant.co.uk. Finally, make sure to subscribe to the ProTax Accountant YouTube channel to ensure your legacy remains protected against all future statutory shifts.